Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is really good. We got some precious time here with Sophia Drossos working for Point72 in New York, but you know, we've got to do this. I mean, it's one of the most fractious marriages out there. Steve Cohen, of course, of Point72, has a modest New York Mets team. You have a Red Sox Mets marriage? Is that true?
Yes, it's a mixed marriage.
It's a mixed marriage, to say the least?
Yes. However, I did adopt the Patriots as my football team because that was that was a deal breaker.
Yes, good for marriage. Good.
And also, you know, the Michigan connection. So for me, when my husband said I'm a Patriots fan, that's a deal breaker for me. I was like, Tom Brady. I knew him since he was number 10.
How's your husband doing? Soto in a Mets uniform is un-American to me. Is he holding up? I mean, the Mets,
Mets Nation is very welcoming. So when we do go to Citi Field, my husband will wear his Red Sox hat. But Mets Nation, super welcoming.
Very good.
Yes.
Good update there. And of course, we are ready for the baseball season. We're also ready, Sophia Drossos, for an economy. And your research note says it all. I think you used the word uncertainty 47 times. What is the character of our economic and market uncertainty?
Yes, well, uncertainty is something that we haven't had to deal with until more recently on the policy front. So last year was a year where there was fiscal spending, there was a preemptive Fed easing, it was very positive tailwinds for the market. And we came into this year with the markets, I think, for the first time in a long time, investors were looking at the glasses half full and taking kind of the upside on economic growth. And the policy uncertainty, I think, has permeated that a bit. So we came into the year with a lot of expectations for deregulation and animal spirits, and the sequencing has brought perhaps the more onerous parts of policy up first, with the uncertainty over trade, how it will end up, how will it affect the economy. And, you know, we're still looking at that April 2 deadline and not quite sure exactly how things are going to pan out or if that will be a clearing event.
So one of the issues coming into this year for the markets was the Fed's probably not going to do a whole lot to help these markets. It's going to be earnings driven. So therefore, I need my economy to be strong. How do you think about the economic outlook and how that might be a challenge potentially for the earnings story?
Yes, well, on the earnings front, we are coming off a period of time where corporate margins have been at record highs and earnings have been quite strong. And if we're coming into a period where economic growth is expected to moderate and there is a lot of uncertainty facing corporations with regard to tariffs, their input costs, and the outlook for the U.S. consumer, it seems more likely that we're going to see a moderation in corporate profits. And I think that this first batch of earnings reports at the end of April will be very key for the market directionally.
I look at what you just said, clearing events. Folks, this is a Midwest pedigreed right here. Michigan and Ann Arbor was basically East Chicago. It comes back to Knightian uncertainty. And, it almost folds into what Friedrich Hayek would say, which is you've got these clearing events where things clean out. So on April 3rd, you suggest we may have enough clarity to go long?
Unfortunately, I don't think we'll have the clarity on April 3rd. So the issue has been on April 2nd, we are anticipating to get a sense of the blueprint on the reciprocal tariffs. But the commentary from the White House has been that there's likely to be ongoing tariff threats in terms of specific industries and products. So on April 2, we'll know a bit about this reciprocity that will be going on, but we won't know enough about what's going to happen with specific sectors.
Not without giving away the .72 cards, but the basic idea here is with this colossal uncertainty is, and this is a bit off your remit, but I'm going to ask anyways and be rude, is cash a preferred asset right now?
Well, I've been looking at things like gold and cash. Yeah. Gold has been performing incredibly well. And so in an environment where investors might see some risks, asset allocation theory would suggest trying to increase some of your safer holdings. And there are different views on treasuries and the fiscal trajectory. So investors, I think, have increasingly been looking at things like cash and gold.
Oh, I mean, talk about gold.
Crazy.
Juan Soto, $75 million signing bonus.
Good for him.
765,000 guaranteed. Excuse me, I'm off. 765 million guaranteed, and he's underpaid at 51 million a year.
Sure. Good for
He's
him.
got a base of 46 large.
Guy can hit. I mean, you can.
He's great.
Better.
He's
Yeah.
like the second coming of Wade Boggs.
Seriously. We'll head out to
with a little more power.
City Field, no question.
It's great.
Sophia, what are we doing?
If we talk enough about the Mets, can we get box?
we'll
box
get the
seats?
box seats. So we'll go.
One more question. Get it in there.
Quick, fixed income. Do I take credit risk or not? Here, do you think?
So it's an environment where I think we have started to see a little bit of a pickup, I think, in the delinquencies and the like, but the types of credits that are in public markets are typically relatively strong. I think the bigger question is what's going to happen with the outlook for the economy and what does that mean for all U.S.-based risk assets?
When you go to Fenway, just gaze out at the Ted Williams red sea. Make me happy. Sophia Drossos, thank you so much. With Point72, just fabulous over the years with a wonderful synthesis of economics and the impact on our investment.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Joining us right now, folks, it's like I'm chopped liver. I mean, it's all there is to it. It's Paul Sweeney and Tom Keene. And we are after her conversation with the legend, Kenny Polcari, over at the New York Stock Exchange. That's trader talk.
That was yesterday.
Okay, what do you say to Ken Polcari that you don't say to me? I mean, that's like in and out of the market, right?
Yeah, look, it is a good reminder that there's all these short-term movements in markets that are driving the volatility that we're experiencing, but you have to keep the long-term in mind, which is why we've been continuously saying to clients, it's not where the S&P 500 ends at the end of this year. It's what you do with the volatility along the way.
Are traders getting slammed as a general statement? I mean, trying to game this market right now? Is anybody making money?
Well, we've certainly seen traders move from being max long equities at the beginning of this year, 98th percentile kind of positioning, to that's now fall into the 26th percentile.
Wow,
so
really?
There's probably been some pain along the way.
Polcari looks like out of Central Casting, Game of Thrones or Outlander or one of those things. I mean, is he retired?
No, he's trucking.
He's trucking. Okay. Just good morning to Ken Polcari and everybody down at the New York Stock
Salomon
Exchange.
Brothers guy back in the day. Your note is the end of U.S. exceptionalism. Is it the end of U.S. exceptionalism, or do we still have room to grow? What do you think?
So what we wrote about is this idea is that it's very easy to ascribe a narrative to price action. Everybody looks at the weakness in the U.S. dollar year to date. They look at the outperformance of Europe versus the rest of the U.S. and they say it must be the end of U.S. exceptionalism. But if you look, it really is a function of the fact that we started the year with a massive, very, very crowded dollar long position that has since been unwound. Traders are now slightly short the dollar.
Is that right?
And we actually think that you could see some dollar stability here now that you've burned off all of that crowded positioning.
Interesting. So what do we, I mean, when you talk to your clients here, again, we had that peak to trough drawdown in the S&P 500 of about 10%. Do they view that as a healthy pullback in an otherwise positive market, or is it something else?
We'd hope that we've talked to clients enough and set up the potential for volatility that there is a degree of calm when we see it. We often talk that volatility is a feature of being an equity investor and that we should see it as opportunity. Now, we think the other reason why there's been this calm is that if you look at a 70-30 portfolio for ACWI, so that's an international balanced portfolio, including the U.S. and the ag, you're still up on the year. So yes, we've seen the U.S. stock market pull in, but at the end of the day, it's not been cataclysmic.
Are we getting used to, I asked Michael Darda, I alluded to this with Michael Darda, more directly with Cam Dawson. Are we needing to slot in the understanding that equities are a single-digit return in our double-digit return addiction?
Yeah, I think that that's very, very likely, is that we've been in this world of very strong double-digit returns the last 2 years. Investors got conditioned to expecting that, which is why you saw these estimates for 7,000 plus in the S&P 500. That's very hard to do when you start the year at 22.6 times forward earnings. You start the year at the 90th percentile of positioning. So our best case scenario for 2025 is that you get growth, upside that's equivalent to earnings growth. Okay. But that assumes that multiples stay constant. And we're not sure if you get multiples staying constant in a world where you're cutting earnings estimates and there's some risk off flavor.
How about Europe? Europe's had a heck of a start to the year here. And that story we had heard kind of last year where European and international money coming into the U.S. market had a little bit of a reversal of that. How do you think about the performance of European equities?
We do think that the easy part is over for European equities. You started at 13.5 times forward. Now you're trading at 15 times. Okay. 15 times doesn't seem like a lot when you compare it to the 20 times in the US, but it is the high of the valuation range and the pre-pandemic range for Europe. So it really comes down to earnings delivering. Quite interestingly, earnings for Europe have continuously been getting cut, even as we've been seeing this rally. So it's a show me story.
Right now, the show me story is Cameron Dawson with us this morning with NewEdge Wealth. We welcome all of you in your commute across the nation. Good morning, 92.9 FM in Boston, 99.1 FM in Washington, Bloomberg 1130 in New York, an ample conversation with Cam Dawson. On YouTube, subscribe to Bloomberg Podcasts. Even Cam Dawson subscribes. It's just
tech savvy.
Put us up to 42 is amazing.
Exactly. You know, I'm looking at the relative strength index, the RSI on the Bloomberg terminal for the S&P 500. Man, we kind of bottomed back just like 10 days ago, but now we're moving higher here. I mean, how do these technicals feel? It feels like, is the sell-off, are we done with the sell-off here, or how do you think about it?
So we certainly got oversold enough to bounce, which is why we think we're bouncing today and yesterday. What the question is, what happens when you hit resistance? And are you having enough momentum to break through that wall of resistance, which we think is around the 5,900, 6,000 level? That's your downward sloping 50-day moving average. You've been losing momentum in this market really for the last 9 months. If you look at things like a weekly MACD. So we do think that this is an environment that you could roll at resistance.
I'm going to go right there because I hate it. I'm not a MACD fan, folks. We won't go into the nuances of it. 1600 Pennsylvania is not looking at the weekly MACD.
No.
I mean, they're not. The bottom line is we can't lift until we get political clarity, right?
Exactly. Why would we trade back up to all-time highs when we've cut earnings estimates since, and we have valuations that would have to go to new highs to get there, which is why we think this year at best is that wide, choppy range because of the degree of uncertainty and because of the potential downsides to growth.
It's depressing. Mag 7, are they still the Mag 7, even ex-Tesla?
We've been raising the question if they're more like the Lag 7. We talked, I think, last week.
Do you see a lessening of their cash flow, free cash flow?
It is happening because of the big uptick within CapEx. You are seeing free cash flow margins come in. Now, these free cash flow margins are still so much better than you can get in the rest of the market.
Exactly.
Yep.
So do they become a safe haven when people have questions about growth other places? Very possibly. The valuations aren't as stretched as they are, but the market cares about second derivatives. The market cares about the slowdown in earnings growth, which is inevitable when they had such massive earnings growth over the past 2 years.
But you said the free cash flow will sustain even if earnings come down.
But it is.
I mean, Zuckerberg's going to manage the P&L statement, right?
And they're sitting on massive, huge cash balances as well that they could deploy to repurchase shares.
So are they the new Dominion Electric? You're too young to know that. Could you get me someone in here older that actually knows what D is? Are they the new utility?
That is an interesting question. If they become such monopolized businesses that they are effective utilities, then it raises the question of, do they get regulated like utilities do? And do we see those free cash flow margins compress over time because of the fact that they act like utilities?
I mean, Paul, you're the only one extant in this building that knows what Florida Power and Light is.
Dominion Energy, based in Richmond, Virginia, home of the
It
Richmond
was.
Spiders.
Look at that dividend growth.
Exactly. Earnings are important for this market because I'm not sure the Fed's going to give us a whole lot this year. Maybe one, maybe two rate cuts. So that puts even more pressure on earnings story. And you mentioned that earnings estimates have been coming down. How risky are the numbers that are out there, do you think?
So we think the biggest risk is possibly within financials. You've been seeing every sector get cut. Financials have seen less earnings revisions lower, but think about the setup for financials coming out of the election. People said a steeper yield curve, we're getting M&A, we're getting IPOs, we're getting deregulation. We've gotten none of that. So we do wonder if that's an area of risk going into first quarter earnings.
Okay, Shanghai, China. Good morning, good evening, I should say. Shanghai, China this morning, listening in. Is China the opportunity Sophia Drossos and Mike Darda were talking about?
Well, China certainly has that valuation opportunity where it still trades at such a huge discount to the U.S. It's underloved. It's been called uninvestable.
So are you going back to a textbook 8, 9, 12, 10% allocation to international?
So we are neutral international. We said you just can't ignore the degree of outperformance in the U.S., underperformance in international, but we don't see signs yet that justifies going to an overweight position.
What are we doing in fixed income here? My 2-year treasury is now back above 4%. Do I stay there? Do I take some credit risk? Where do I go?
So we don't think, again, that you're getting compensated for mostly high yield credit risk. So we moved to reduce some positioning within high yield just to say, let's ride out some of the equity volatility, but we want to be able to take some risk out of portfolios in the event that these growth fears do come to pass.
So in the equity space, what screens well for you guys these days?
So we are finding lots of opportunities within international markets, but very selectively in the big, beautiful quality world. We're finding opportunities within mid caps as well, and then value, lots of opportunities where you still see areas of the market that trade at discounts, that have good free cash flows, have good balance sheets, and it's just maintaining that valuation discipline, which we think is absolutely critical at this point.
What's the key attribute of those opportunities?
The key attribute is that they are not trading at stretched valuations, and they have stable earnings through cycles, and they have good free cash flow that is potentially seeing better free cash flow margins. So it's about being very picky. We think that there's a big divergence between the winners and the losers in this kind of environment.
This guy in Shanghai, it's child abuse. He's got his 4-year-olds watching it. Look at that in Shanghai. Can you see that, folks?
Yeah.
That's cruel and unusual punishment.
Watching surveillance in the morning.
Full disclosure,
evening,
folks, it's my grandchildren. We say good morning to the Rugrats in Shanghai this morning. But, getting back to international and Pacific Rim, I got too much gloom out there. I got guest after guest. Read me the Uncertainty Act. It clears at some point. How do you prepare for the moment where the uncertainty drifts away?
Well, I don't think that you can wait for necessarily confirmation from the data. The important things is that price will lead the data. And so as we're starting to see some of these turns and trends, we have to be there, which is why we moved to a neutral position within international about a year ago, saying it's going to happen, maybe this time.
So is our Federal Reserve going to help us this year, or are you still kind of saying
that's the key question.
A couple of cuts here?
All this talk, folks, Sweeney just asked the money question.
We're not counting on the Fed for anything. We don't think that the labor market is going to be weak enough to justify them cutting. We don't think that inflation is going to move down fast enough to give them the degrees of freedom to cut, which means that get used to these higher for longer rates. And that's why we think that you have this continuous pressure on weak balance sheet companies that you should fade any strength.
So what's your money unemployment rate?
So we don't think that the Fed will cut unless we see mid fours on the unemployment rate.
4.5, 4.6.
4.4, 4.5.
Really? Wow. Come on, it's not that far away.
It's not that far away, but we don't see this sharp deterioration in the labor market happening at this point. Yes, we see the sentiment around labor deteriorating, but we've not seen companies move to full force layoffs that just suggest that there still is that underlying stability. For now.
Yeah. So, it's interesting. One of the questions is, I think for a lot of people is, do I take this pullback to buy stocks here? Or is there just more uncertainty out there because it's just one tweet away from another pullback in the market?
If you're buying stocks because you think it's going to be a V-shaped recovery and it's up and to the right with low volatility, it's the wrong move. But if you're buying stocks to say, I'm going to own this for a long time, I'll step into volatility, we think you can still buy weakness.
All of China's listening this morning to Cam Dawson. The entire nation just went to cash. Cam Dawson, thank you so much. NewEdge Wealth this morning.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Michael Darda is with Roth Capital. And years ago, he came out of the Wisconsin Combine and got a job with one of the rock stars of linking markets into economics, Jude Wanniski. And Darda just penetrated right through with brilliant research notes, melding investment into economics. Michael Darda, wonderful to have you on the show today. I'm looking at Atlanta GDP now. I've got a real GDP guesstimate negative. Maybe it's a little positive. I got PCE coming in with some kind of disinflation. Are we in the middle of a nominal GDP collapse?
Thanks for having me on, Tom. I don't think nominal GDP is collapsing. I think what we're facing here is a series of adverse supply side shocks that will slow real growth and temporarily raise inflation. And that is unfavorable because for any nominal growth rate, you want most of it to be real, not inflation. And you can see that embedded in the Fed's forecasts with the SEP last week, where they reduced their expectation for real GDP for the year, but they increased their expectation for inflation.
Yeah, I saw that.
And they reduced the real growth expectation about twice as much as they increased the inflation expectation for the year. So nominal growth expectations didn't collapse, but they have eased implicitly. Right. That's looking for about 4.4% nominal growth. That's certainly below the 5% rates that we've been seeing recently, consistent with the soft landing, and less of it's going to be real. So it's a bit of a stagflationary flavor there, Tom.
So, Michael, bring it right over to the investment world. Does that mean reduced revenues where I've got operating margins coming in and all of a sudden Sweeney's getting gray hair because earnings are coming in?
Yeah, that's exactly what it means. So slower top line growth and higher costs. And, that is a risk to these very elevated expectations for S&P 500 earnings this year. At the start of the year, analysts were expecting more than 14% earnings growth. Our model that uses high yield debt spreads and the new orders index from the ISM data suggests that, low single digits is more likely. And, unfortunately, you have pretty high valuation still on those lofty expectations. So, we'll see if markets can continue to look through this uncertainty. We've rallied over the last few sessions, but, I think we still might have some volatility ahead.
So it seems like one of the key dates coming up here, Michael, is April 2nd, when we get a clearer picture of some of these tariffs here. Just stepping back and thinking about tariffs, is it a good thing to bring more manufacturing back to the U.S.? Is that a realistic and a meaningful goal of tariffs, do you think?
Well, the administration certainly seems to think so. They want to do it for so-called critical industry. If the U.S. has an emergency or goes to war, they want those critical industries here and able to fire up at a moment's notice. But in economics, everything comes with a trade-off. And so if we're deploying capital and labor into industries that we're less efficient at than they would be in other places, then those same resources can't go into making other export goods. So there is a second and third order drag on efficiency, productivity. So the question is it worth it to give that up? And that's what markets are grappling with now.
So one of the concerns here, the immediate concerns, Michael, of this marketplace is this thoughts of stagflation, where the growth is kind of slowing, inflation's kind of creeping back up, maybe due to some of these tariffs. Who knows? Is stagflation something we should be worried about?
Yeah, it certainly has that flavor because I think after the election, there was a lot of optimism that whatever happened on trade would be offset by fiscal policy and deregulation. And so far, we don't really know, the deregulation piece is kind of a question mark. Right. The administration's going very hard and fast with the tariffs, a bit of an on again, off again, on again approach. But I think that really challenges some of the assumptions coming into the year, which were that the tariffs were simply a bluff or that would be offset by deregulation and potential tax reform. Very difficult to see any kind of a big easing of fiscal policy considering the constraints, and deregulating crypto, I think, is highly unlikely to offset Smoot-Hawley 2.0.
Torsten Slok, Apollo Global Management, channeling Paul Sweeney, I say, puts out a note moments ago, stagflation risk rising. Michael Darda giving us some good knowledge on that. Good morning, an extended discussion with Michael Darda, Jim Bianco coming up in the 9 o'clock hour. Mr. Darda here on the markets, linking in to our economy. And now, folks, the Darda rabbit hole. Does M1, M2, MO, money supply, monetarism, Michael Darda, does it matter anymore?
Oh, I love that question, Tom. I'm one of the few that still watches those indicators, right? And so we had a huge explosion in the monetary aggregates going into the high inflation period in 2021-22.
Stimulus, come on, we stimuli, that's plural.
We did massive,
Stimuli is plural. Okay.
Yeah, so they were good proxies for massive stimulus and a huge ramp in nominal relative to the productive capacity of the economy, which was constrained during the pandemic, right? Productivity basically was frozen for 2 years, and we had double-digit increases in nominal demand on the back of all that stimulus. So that's your inflation story. And in the wake of the Fed tightening, 530 plus basis points, those aggregates slowed very sharply. It turns out, the Fed was able to preside over this once in a lifetime soft landing. So nominal slowed, but it didn't crash.
Yeah.
The supply side of the economy picked up after 2022. That's a critical piece of the soft landing, and why the slowdown in those aggregates, I think, did not foreshadow a recession this time. And now we're putting that at risk with supply side disturbances, which are frankly a series of self-inflicted blows.
Michael, we're going to get UMich sentiment data this Friday. A couple of weeks ago, the University of Michigan data really suggested that people are concerned. Their current sentiments are really took a hit here. Inflation expectations moved decidedly higher. When you see soft data like that, does that get your attention?
Yeah, it's, the survey data is really a set of inauspicious recent outcomes with confidence pulling back and inflation expectations shooting up. So that's not really what you want to see, obviously. We're going to get some conference board data today for March, and that data has also been soft, not quite as, weak as the UMich data. But the key question is this soft data a harbinger of much weaker hard data coming down the pike? And we just don't have the answer to that yet. And we won't even this week. We've got some February data coming up on Friday on personal income and consumption and the deflators the Fed watches, but still a little bit stale on some of this hard data. And that's really the risk that markets face. We know the soft data doesn't always translate one for one into hard data, but obviously the risks of the hard data rolling over with this hit to confidence have increased.
I mean, Michael, right now we've cratered on the Standard & Poor's 500. I think we're down 7% or some silly number like that. David Kostin and the crew at Goldman Sachs made a splash with some fancy mathematics that put the regression trend of earnings down to be polite, low single digit. Do you have almost a Darda assumption of a single digit stock market forward, or do you maintain double digit growth with operating leverage?
I think it's going to be really hard to maintain that double digit growth. I mean, if you just do a super basic Tom Keene scatter plot regression on forward PEs and 10-year future returns, coming into the year with the forward PE 22x, typically that's a level where you see very weak, potentially even negative 10-year forward returns. So the higher the valuations, the lower the longer term forward returns are. And, that's a little bit of a different game than the chase that's been on with momentum. And then more broadly, I do think that these disruptions to the supply side eat away at the earnings expectations. And so the high valuations are pricing in good times continuing. And now we're starting to question that, which is, why we've seen more volatility in this pullback, which frankly has been pretty minimal so far. In the S&P 500, even at the lows on the 13th of March, was still above a 20 forward multiple. And, that's still 10-12% above the 10-year moving average, which, I think is very generous because the 10-year moving average is well above longer term historical averages. So this is a high valuation market still. And I think investors that are going to just jump right back in and chase what was working for most of the last 2 years could be a bit disappointed.
We're hearing more and more potentially about a recession. Michael, is that kind of in your 6 to 12 month forecast at all?
Well, I mean, obviously, Paul, I think that the risks have gone up, relating to the soft data really weakening. If that was not underway, then obviously the risks would be lower. It's sort of a shame because, the Fed has been able to preside over this immaculate disinflation and soft landing that's been underway for the greater part of nearly 2 years now. And that is a very rare historical event against all odds. And we've had a lot of excitement about the AI story. Productivity has been picking up over the last 2 years. I don't think that's really AI, but the reversal of pandemic-oriented distortions. Right. All of that could be put at risk now.
One final question, Michael. We're out of time. Yeah. Critical. Is Nantucket and Martha's Vineyard real estate going to crack?
It's softening. A lot of these super hot markets are softening, but the gains that we're seeing from 2020 through 2022 into 23 were historic. So we do have an affordability problem, and not just in those super hot markets.
May your manse not fall into the Atlantic. Michael Darda, thank you so much with Roth. Greatly appreciated this morning. A terrific brief there.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Today we celebrate Phil Taze would come in here and we would talk to him about, the market, and he would mention the word uncertainty 14 times. Taze Asset Management. But today we celebrate a really challenging book, and it's a particularly important book if you're missing the retirement ballet, the behavioral portfolio, managing portfolios, and investor behavior given a complex economy. Congratulations on timing here to have the amount of uncertainty we have on the release of the behavioral portfolio. You've got a whole section on the great dilemma of a retirement undershoot. Mm-hmm. Are we investing too cautiously because we're scared stiff?
Yeah, so what we're doing is we're ignoring a significant chunk of history, Tom. I mean, the two episodes I point out, number one, the 36-year bond bear market that happened between 45 and 81 is completely not excluded from people's planning when they're planning for portfolios. But obviously the big one is the Great Depression. And what I do in the book is I do what I call a visualization of what a balanced portfolio would look like during the Great Depression. In the first 3 years, it's down 72% if you're taking distributions. Then we have a 5-year bull market, but then another 5-year bear market. It's unnavigable. So what the entire investment community is doing, as brilliant as it is, and it is brilliant, is deciding we're going to look back 50 years and we're going to base all of our planning based on that. And we're going to exclude anything before that looks like it might be a nuclear bomb.
But my mother and my father, classic Depression babies, kept waiting every 5 years for the next depression. Let's, as a general sense, say it didn't come because of credit expansion, whatever the reason, maybe World War II, who knows? Are you predicting a 1930s?
We're not predicting it, but the one thing I'll say is that if you look at certain elements, so for example, when's the last time we had 100% debt to GDP in every developed nation in the world, essentially? When's the last time we had a declining demographic population in every developed country in the world? And also, when had we been at sort of record price to book, like we were in the internet bubble burst? So I think what you need to do is say, look, we're going to go ahead and include this history, and instead of making a prediction for down markets, we're going to say, this could happen again. And by the way, based on where all the data is right now, it might actually be more probable than not.
Talk to us about the 60-40 portfolio. I'm teeing you up here, bro. Go.
Well, so, the 60-40 portfolio is an historical accident. Bonds were created to fund governments and later fund companies. Stocks were created to share ownership. At some point, someone came along and said, let's put these two things together. And sometimes it's an effective diversifier. Sometimes it's not. But I think what's interesting is that, Warren Buffett said derivatives were a weapon of mass financial destruction. Actually, you can use derivatives, option contracts, and things like that to create real negative diversification. So our strategy is what we call a behavioral portfolio. It's what I lay out in the book. And what it does is it says take half of your equities and put it into hedged equity strategies so that it can uncorrelate from negative economic activity like the Great Depression.
Fine.
Yeah. And for the fixed income side, be adaptive.
Everyone listening worldwide is saying, okay, so this is the Phil Tay's gold exercise where I got right now a linear extrapolation in gold, which is 80-ish, 1980-ish. Is gold part of the behavioral portfolio?
It's not. Gold can be a great diversifier. The problem is over the very long term, it just produces, CPI, right? So you can have moments in time when you get some appreciation, but what you need to have are instruments in the portfolio that can produce verifiable, reliable, long-term above inflation growth or income.
Okay, so is that Apple? Is that Apple? I mean, I got a use of cash and free cash flow with Apple that at least X depression. Paul, I mean, Paul, if we have a depression, we're still buying 6 toys a year.
Exactly.
But are big free cash flow quality stocks appropriate in a portfolio of gloom?
Yeah, absolutely. So by the way, I'm not a doom and gloomer. I'm a boom, boom, kaboomer. So you got to embrace the boom. A boom, boom, kaboomer. You embrace the boom. You acknowledge the possibility of the kaboom. I want to create a kaboomometer. But look, half of the equities portfolio needs to be in conventional stuff. And so the things that have done so well, if you're positioned in that, plus you're positioned in it with hedges on the other side too, you've still got your 60% equity allocation. Just half of it is hedged in case things move down. But absolutely, you need companies like Apple in your portfolio.
How about alternatives? Where do alternatives fit into an investor's portfolio?
So one of the criteria in the book that I lay out is what I said before. It needs to be a reliable provider of growth or inflation. So think about one alternative, which is managed futures. Managed futures is essentially just a less than zero sum game with a potentially really good manager. So I would say that would not qualify. So if you look under the hood and see what's the engine of growth, if it could be something like stocks or some other source of reliable growth, then you go there.
Phil, thank you so much. Congratulations. Phil Tay's here. A lot of work. Tay's Asset Management, the behavioral portfolio. I'll put it out on Twitter and LinkedIn. A very nice, concise read on something not talked about enough, which is what if.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
The newspapers this morning, just too much. What can we say here? It goes on and on. What's going to be a 25-minute block, but we'll do it right now too quick. Lisa Mateo, what do you have?
We have the condensed version for you. Okay, we've been talking about retailers, right? Bulking up their inventories to get ahead of President Trump's tariffs. So imagine companies like my beloved Costco, yes, Williams-Sonoma, they are stockpiling goods. But here's the difference. The Wall Street Journal talked to a couple experts, and they're saying, you know what, this is risky because consumer spending has slowed. And now you risk getting stuck with a ton of goods that are just stocking up in inventory. The ports in Los Angeles, Long Beach, California, they're starting to see the influx already from this. But the thing is, it's not just the tariffs. They were already stocking up on the merchandise because you had them, worrying about the strike at the ports.
Okay.
Yes, and they were also worried about, trying to get ahead of the Lunar New Year before the factories close across Asia for like 2 weeks. So it's this continuing stockpile of goods.
But again, it's the uncertainty to April 2nd. I mean, that's all this comes down to.
Correct.
That Sophia was talking about.
So the inventory risk. Okay, so if they get too
so they're
much
saying,
inventory,
what, it's not the best idea. They're taking a risk when they're doing this, but I couldn't imagine stockpiling Costco goods. That's a lot of stockpile.
Exactly. We're going to put all
the... Is the egg thing solved?
Well, let me get the egg
the
stuff
prices are starting to go down, so that is the good news. So Yeah.
Like,
The egg thing.
I paid $12. Everything was gone.
Yeah.
Sold
Still?
out. Except for the $12 eggs.
I'll give you the update. I'm heading to Costco this
here we
weekend.
go. So I'm doing the USDA large eggs prices paid to producers Midwest. So we've had a big pullback here.
Do you do this at home?
I've got it here.
Do you look
It's
this
got-
up
it's
on your
on the
Bloomberg
terminal.
terminal?
It's down 55% just in the last month. So we're down.
Do
We went
you
from
have a can of Budweiser in your hand. You're on the deck watching the
Bloomberg
Dolphins.
terminal's got everything.
And you
What
got a
can I tell you?
terminal on the deck. It's waterproof. Next.
Okay, not sure what everyone at home with their high schoolers are doing for spring break. My daughter is playing softball. That's
Okay.
how she's spending her spring break. But last week, hundreds of wealthy New York City high schoolers, a dozen private elite schools, they had their annual retreat. And their annual retreat is Paradise Island in the Bahamas.
Get out.
Yes, you know, the luxury Atlantis resort. Yes,
Really?
I've been there once. It's amazing.
Does look pretty cool.
Gambling, drinking ages 18 also.
Good to know.
But they dine at they have Nobu restaurant, $34 sashimi, $65 lobster salad. They get these networking opportunities, right? And the parents are dishing out nearly $3,000 for
Whoa,
5 days.
A
Tom, how come you're
networking
not doing that?
opportunity.
Networking opportunity because of the
you're not doing that, Tom?
alumni who went to the school. They get to intermingle with them.
This
So,
came up
yes.
at the dining room table last night.
I did not know this existed
Do you know what
in New
my
York.
punishment is? Because we're not doing this. We had to get our hair rainbowed. You don't get your hair dyed anymore. You get it rainbowed.
Rainbow? Do you do the nose ring too?
I
While
don't
you're
know. I wasn't allowed to see what it cost. Next.
It's
Wow.
a lot. It's a lot. Yeah. So, okay. So we'll stick with luxury here. We go to more airlines. We talked about Air France last week, beefing up their new first class suite, Le Premier. So
Nice.
now we have British Airlines joining in. The Financial Times say they're trying to regain the status. So they want to put in more than $7 billion. They're investing in this program. So they have this commitment to luxury now. First class passengers. They have this suite that they can go to, more than 6 foot long bed.
Oh,
they
that's
can
for Tom
enjoy
Keene
it.
right there.
6 foot long bed.
Yeah.
You can certainly fit in that one. Stretch out, enjoy the trip from New York to London. How does
That's
that
what we're
sound?
It's a short trip, though. The thing
It
I
is.
don't get.
If you got the wind behind you, it's
I can get, you're rolling to
How long?
Singapore or whatever.
Yeah.
It's like 5 hours if the wind's right.
Yeah.
It's like going to California.
Yeah, it's like it feels like.
Feels like-
I mean, do you want to spend that kind of money? The La Premiere to Paris is. I'm sorry, it's 10, 11, 12 grand round trip. That's a lot of that. You get an extra hour to Paris.
Okay.
It-
Is it worth
it's not
it?
like going. It's not like going New York to,
No, I can
Pittsburgh.
get to
but-
Dublin faster than I can get to a lot of places.
Exactly. Like Aer Lingus is like you're
Yeah.
popping over there.
Yeah.
You're there.
They love me over there.
Okay.
All right, good
Lisa
stuff.
Mateo, thank you so much on the newspapers. We'll see you in the Bahamas.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.